Most people are not watching the bond market right now. They are watching stocks, they are watching crypto, they are watching their house value, they are watching everything except the one market that controls the price of everything else. Peter Schiff is watching the bond market. He has been watching it for years. And what he is seeing right now is a breakdown that has already started, that almost nobody has priced in yet. And that is going to hit stocks, housing, and crypto in a sequence that he says will make 2008 look like a dress rehearsal. Today, Peter Schiff explains exactly how the dominoes are lined up, why the bond market is the first one to fall, and what you need to do right now before the rest of them follow. This one is important. Pay attention. Let's get into the video.
I want to ask you something before we get into any of this. Do you know what your mortgage rate would be if you tried to refinance your house today? Do you know what a car loan costs right now? Do you know what a business owner pays to borrow money to keep their doors open? Because here is the thing about those numbers. They are not random. They are not set by banks. They are not decided in boardrooms. Every single interest rate you encounter in your daily financial life, every rate on every loan, for every house and every car and every credit card and every business line of credit in this country flows from one place, the bond market. The United States Treasury bond market is the foundation upon which every other interest rate in America is built. When Treasury yields rise, everything gets more expensive. Mortgages, car loans, business credit, credit card rates, the cost of carrying the national debt itself. Every single financial relationship in the American economy becomes more expensive when Treasury yields go up. The 10-year Treasury yield is currently sitting near 4.5%. The 30-year is climbing toward 5%. And I need you to understand something that the financial media is not explaining clearly enough. Those yields are not going down. They are going up. And the consequences of that direction, consequences that are already beginning to ripple through every corner of the economy, are going to be far more severe and far more widespread than most people are even beginning to prepare for. The bond market is already breaking. Stocks do not know it yet. Housing does not know it yet. Crypto definitely does not know it yet. But they are going to find out. And when they do, the conversation about what to do with your money is going to be completely different from the one most financial advisors are having with you today. Let me show you exactly how this works, because once you understand the mechanism, once you see how the bond market connects to everything else, you will never be able to unsee it, and you will understand why I am more alarmed right now than I have been at almost any point in my career. What the bond market actually is, and why most people ignore the most important market on earth. Most people have never bought a bond. Most people could not tell you what a Treasury yield actually means or why it moves. And I understand that. The bond market does not have the drama of stocks. It does not have the cult following of crypto. It does not have the emotional attachment of housing. It is dry. It is technical. It is the kind of market that only gets attention when something goes wrong. Something is going wrong. Here is the simplest way to understand how the bond market works and why it matters to you personally, even if you have never owned a single Treasury bond in your life. When the United States government spends more than it collects in taxes, which it does every single year by approximately $2 trillion right now, it has to borrow the difference. It borrows by issuing Treasury bonds. It offers these bonds to investors and says, lend us money for 10 years or 30 years, and we will pay you back with interest. The interest rate the government has to offer, the yield, is determined by the market, by what investors demand in exchange for lending their money to the United States government for that period of time. And what investors demand depends on several things: how much risk they think they are taking, how much inflation they expect to erode the purchasing power of the fixed payments they will receive, and whether they believe the dollar they will be repaid in will be worth anything meaningful when the bond matures. When investors get nervous about any of those things, when they start demanding more compensation for the risk of lending to an indebted government with a weakening currency and persistent inflation, yields go up. Yields are going up right now. And the reason they are going up is not some temporary technical market move that will reverse next month. The reason they are going up is the same reason they have been going up for the last several years, And the same reason they will continue going up until something in the system breaks. The United States government is a borrower that cannot stop borrowing and cannot honestly repay what it has already borrowed. And the market eventually always prices that reality in. I have been watching this play out in slow motion for years. And right now, the slow motion is speeding up in a way that tells me we are getting much closer to the moment when the rest of the financial system has to reckon with what the bond market has been trying to say for a very long time. The domino that nobody is watching and why it is already tipping. Here is what I want you to understand about how a bond market breakdown spreads through the rest of the economy, because it does not happen all at once. It happens in a sequence. And understanding the sequence is what allows you to act before the consequences arrive rather than after. The first domino is always the bond market itself. That is the domino that is already tipping right now. Yields rising, bond prices falling. The value of existing Treasury bonds held by banks, pension funds, insurance companies, and institutional investors declining quietly but relentlessly as rates move higher. Now, here is the part that most people do not think about. Banks hold enormous quantities of Treasury bonds. When those bonds were purchased at lower yields, when rates were near zero in 2021 and 2022, the bonds were worth their face value. As yields rise, the market value of those bonds falls. The banks are sitting on losses that do not show up in the headlines every day, but that are absolutely real and absolutely consequential. We got a preview of what happens when this pressure becomes visible. In March of 2023, Silicon Valley Bank collapsed, not because of bad loans, not because of fraud, because rising interest rates had destroyed the market value of the Treasury bonds it was holding, and when depositors started to leave, the bank could not sell those bonds without crystallizing enormous losses. It was a bank run triggered entirely by the bond market consequences I am describing. Silicon Valley Bank was not an isolated incident. It was a warning, a preview of what happens when the rate environment I am describing puts pressure on financial institutions that have not positioned themselves for it. And the pressure has not gone away since March 2023. It has gotten worse because yields have continued to rise and the unrealized losses on bond portfolios across the banking system have continued to grow. The first domino is tipping. The question is, which domino falls next? And the answer is the one that affects more ordinary Americans than any other financial variable in their daily lives: housing. Let me tell you what is happening to housing right now, and I want you to really hear this because it directly affects most of the people watching this video. The 30-year fixed mortgage rate today is approximately 6.5%. Just 2 years ago, it was below 3%. Think about what that means in practical terms. A family that could afford a $500,000 home at 3% mortgage rates, paying roughly $2,100 a month on a 30-year loan, is now looking at a monthly payment of approximately $3,200 for the same house at 6.5%. $1,100 more per month for the exact same house. And the house has not gotten cheaper to compensate. Home prices remain near their peaks because sellers who locked in mortgages at 3% are refusing to sell and give up their rate, creating an inventory shortage that is keeping prices artificially elevated even as affordability has collapsed to the worst levels in decades. This is not a stable situation. It is a pressure cooker. And as mortgage rates continue to rise with Treasury yields, as the buyers who can actually afford the monthly payments become fewer and fewer, the pressure in that cooker is going to have to release somewhere. It releases in price, not gradually and gently. In housing markets, in real estate markets, price corrections are always sharper and faster than the people who are too comfortable to see them coming expect. Because housing is an illiquid market. Unlike stocks, you cannot sell your house in 30 seconds when sentiment shifts. When the selling pressure comes, it comes against a thin market with limited buyers. And thin markets with limited buyers produce price declines that shock the people who thought real estate only ever goes up. I said in 2006 that housing was in a bubble. I was right. I am saying now that housing is in a more precarious position than it was in 2006 because at least in 2006, mortgage rates were manageable and affordability was not already destroyed before the correction began. Today, affordability is already broken. Today, the correction has not even started yet. And when it does, the people who bought at the peak with high-rate mortgages on overvalued properties are going to experience the full weight of what that combination means. Stocks, the last ones at the party and the first ones surprised when the music stops. Now let me talk about stocks, because the stock market right now is doing something that I find genuinely extraordinary and not in a good way. The S&P 500 is trading at valuations that are only justified if you believe several things simultaneously. That interest rates are going to come back down dramatically and soon. That corporate earnings are going to continue growing at a healthy pace even as borrowing costs rise and consumers feel the squeeze of higher rates on everything they owe. That the AI spending that has driven much of the recent market narrative is going to generate returns that justify the $1 trillion being poured into it. And that none of the risks I am describing, the bond market stress, the housing correction, the dollar weakness, are going to materialize in a way that meaningfully impacts corporate America. You have to believe all of those things simultaneously for current stock valuations to make sense. And I do not believe any of them. Here is how the bond market kills stocks. It does it through two separate mechanisms that work together like a pincer movement. The first mechanism is through valuation. When interest rates are low, the present value of future earnings is high. Investors are willing to pay more today for earnings that will arrive years from now because the cost of waiting is low. When interest rates rise, the present value of those future earnings falls. The higher the rate, the less a dollar of future earnings is worth today, which means that a rising rate environment is a mathematically hostile environment for stocks valued on future growth projections. And a lot of the most popular stocks in the market right now, the AI names, the high multiple technology companies, are valued almost entirely on future growth projections that discount very painfully in a higher rate world. The second mechanism is through the economy itself. Higher interest rates do not just make future earnings worth less mathematically. They make earning those future profits harder in practice. Consumers carrying credit card debt at 20%, business owners borrowing at rates that make expansion uneconomical, homeowners locked out of the housing market by unaffordable mortgage rates. These are not conditions that support robust consumer spending and strong corporate revenue growth. They are conditions that squeeze the real economy from every direction simultaneously and eventually show up in earnings that disappoint the optimistic projections the market has already priced in. When those disappointments arrive, when the earnings that were supposed to justify today's valuations come in below what was expected, the repricing happens fast, not over years, in weeks, sometimes in days, because stock markets are liquid and efficient at pricing new information. And when the new information is that the earnings story that justified the prices was wrong, the market adjusts without mercy and without sentiment. I want you to think about something. In 2022, when the Federal Reserve started raising rates, the NASDAQ fell approximately 33%. The S&P fell approximately 20%. That was the first round of the market processing a higher interest rate environment. And rates at that point were only getting started. Now rates are higher. They are going higher still. The bond market is pricing in a longer period of elevated rates than anyone was expecting even 6 months ago. And the stock market somehow has decided that this time the rates do not matter, that this time the valuation math does not apply, that this time AI changes everything enough to make the arithmetic of interest rates irrelevant. That is not analysis, that is hope. And I have spent my entire career watching the market educate hope at great expense to everyone who confused it for a strategy. Crypto, the last thing standing that has not yet gotten the message. And then there is crypto, the asset class that its believers say is completely uncorrelated to everything else. The digital gold that is supposed to hold its value while everything else falls. the decentralized currency that the traditional financial system cannot touch. I have some news for you about all of that. Bitcoin is currently sitting approximately 49% below its all-time high of $126,000 reached in October of 2025. 49%. The asset that was supposed to protect you from exactly the kind of monetary chaos I am describing has already lost nearly half its value from its peak. And here is what I find most telling about that drawdown. It happened during a period when gold was going up, during a period when the dollar was weakening, during a period when all of the conditions that Bitcoin bulls said would drive Bitcoin higher were present and worsening. Gold responded the way a real store of value responds. It went up. Bitcoin went down 49%. This is the thing about Bitcoin that I have been saying for years while being told I do not understand technology or innovation or the future of money. Bitcoin does not behave like gold. It does not respond to monetary stress the way gold responds to monetary stress. It responds to risk appetite the way technology stocks respond to risk appetite. When investors are confident and speculative, Bitcoin goes up with the tech stocks. When investors get scared and start reducing risk, Bitcoin goes down with the tech stocks, sometimes more. I said it specifically about the correlation, and I will say it again because it is important. When tech stocks go down, Bitcoin is going to go down a lot more. Now consider what happens when the bond market breakdown I am describing accelerates, when stock valuations come under serious pressure from rising rates, when the earnings disappointments start to accumulate, when investors who have been risk-on for years suddenly decide it is time to reduce exposure and preserve capital, they are not going to sell gold. They are going to sell the risky stuff, and crypto is the riskiest stuff. It is the highest beta risk-on asset in the world. When the margin calls come, when the forced selling starts, crypto gets sold first and hardest because it is the most liquid way to raise cash quickly, and it carries the least emotional attachment for institutional investors who own it for performance rather than conviction. MicroStrategy, now called Strategy, the company that Michael Saylor built into the largest corporate holder of Bitcoin, with more than 840,000 BTC on its balance sheet, has already started selling Bitcoin to fund dividend payments. Think about what that means. The company whose entire identity is built around never selling Bitcoin, whose CEO has spent years saying Bitcoin is the hardest money ever created and they will hold it forever, is selling it. Not because they want to, because they have to. Because the financial pressure of carrying that much Bitcoin on a balance sheet in a rising rate environment is creating obligations that require cash. And when the biggest believers are forced to sell by financial reality, that is not a good sign for the believers who bought because of the believers. The Federal Reserve's impossible choice and why every option makes gold more valuable. Now I want to tell you what the Federal Reserve is going to do about all of this, because the Fed is not sitting back watching this happen without feeling enormous pressure to respond. And understanding what the Fed is going to do and what every option available to them means for your money is the key to understanding why gold is not just a good investment right now, but the most important investment you can make. The Fed faces what I call the monetary impossible trinity. Three things it desperately wants to do simultaneously and can only achieve two of them at best. It wants to control inflation, it wants to support economic growth, and it wants to maintain the credibility of the dollar and the Treasury market. If the Fed raises rates or holds them high to fight inflation, economic growth slows, the housing market gets worse, the stock market comes under pressure, the government's interest burden increases, political pressure becomes overwhelming. If the Fed cuts rates or prints money to support growth and markets, inflation comes back. The bond market sells off further as investors demand higher yields to compensate for the inflation risk. The dollar weakens. The real value of savings accounts and bonds and fixed income investments evaporates for ordinary Americans who are counting on them. There is no third option. There is no clever policy that achieves all three things simultaneously. The Fed has to choose, And if you look at the history of what central banks choose when they are facing this kind of impossible arithmetic, when the political pressure is mounting and the economy is slowing and the markets are falling and the government cannot afford the interest on its debt at current rates, they always choose to print money, always, without exception. Every single time this situation has arisen in modern financial history, the central bank has chosen monetary expansion over fiscal discipline because monetary expansion is the option that buys time. The damage is real and it is severe, but it is invisible and gradual in ways that political leaders can survive. Austerity and high rates are painful and visible and immediate in ways that political leaders cannot survive. They will print, they will cut, they will call it whatever they need to call it, quantitative easing, emergency liquidity facilities, special programs with reassuring names, but the effect will be the same. More dollars chasing the same amount of real goods and services, more currency debasement, more purchasing power lost by everyone holding dollar-denominated savings. And in that environment, the single best performing asset in all of recorded financial history across every episode of currency debasement and monetary expansion and government debt crisis that has ever occurred is gold. Not because gold is exciting, not because gold pays a dividend, not because gold is going to disrupt anything or innovate anything or change anything about how the world works, because gold is honest money in a world of dishonest currency, because gold cannot be printed, because gold does not make promises that governments then have to break, because gold has been sitting quietly for 5,000 years, watching every fiat currency in history eventually fail and outlasting every single one of them. Gold is above $4,000 an ounce right now. Morgan Stanley, Goldman Sachs, UBS, the same institutions that ignored gold for years while it was cheap are now putting out price targets of $5,000 and beyond for this year alone. Not because they suddenly discovered what gold bulls have been saying for decades, because the mathematics of what is happening in the bond market and the dollar and the debt are now too obvious to deny. I have been buying gold since it was $250 an ounce. I have been right. I am buying more right now. Not because I am trying to be vindicated after years of being called a broken record, because the evidence has never been clearer and the opportunity has never been more time sensitive. What you should do right now, not eventually, right now, let me be direct with you in a way that I do not think most financial advisors have been direct with you, because I think the situation demands directness, and I am not in the business of making people feel comfortable at the expense of making them prepared. If your retirement savings are primarily in a traditional 60-40 portfolio, 60% stocks and 40% bonds, you are holding the two asset classes that are simultaneously under the most severe structural pressure of any environment in the last 40 years. Bonds are getting killed by rising yields. The bond portion of that 60-40 portfolio is not a safe haven right now. It is a guaranteed way to lose purchasing power as rates rise and the value of existing bonds falls. Bonds are clearly the biggest victim of inflation. If you own bonds, inflation kills you. There is no hedge in that position. And the equity portion, the 60% in stocks, is vulnerable to exactly the valuation pressure and earnings disappointment that I described earlier. It is not diversification if the two things you own both fall together. And in a rising rate environment driven by monetary stress, stocks and bonds have historically fallen together. The investments that survive this environment are not complicated to identify. The problem is never identifying them. The problem is acting on what you know before the situation forces your hand. Physical gold, physical silver, real assets that produce income and that adjust their revenue with inflation. Exposure to international markets not entirely dependent on the health of the dollar, and a commitment to reducing exposure to the assets that are most vulnerable to the environment I am describing. Long-duration bonds, high-multiple speculative stocks, and cryptocurrencies whose value is driven by risk appetite rather than monetary fundamentals. I am not asking you to panic. Panic is never the right response to anything. I am asking you to look at what the bond market is telling you, to understand that the yield on the 30-year Treasury climbing toward 5% is not a technical anomaly that will self-correct. It is the market pricing in the reality of what the United States government's fiscal position actually is, and to position yourself accordingly while you still have time to do it thoughtfully rather than desperately. The people who are going to look back at this moment as the decision that changed their financial lives are not going to be the ones who waited for certainty. Certainty in markets always arrives too late to be useful. The people who benefit from what I am describing are the ones who understood the mechanism, saw where the dominoes were lined up, and moved before the first one finished falling. The bond market is the first domino. It is already moving. Everything else is next. The only question that matters right now is which side of that sequence you are going to be on when the rest of them follow.
The bond market, the most important market on earth and the one most people have never once looked at. Peter Schiff says it is already breaking. The 10-year yield is over 4.5%. The 30-year is over 5. And what happens in bonds does not stay in bonds. It moves through the entire financial system into stocks, into housing, into crypto, in a sequence that has already started, whether you are ready for it or not. Your action this week is this: look up the current 10-year Treasury yield. Watch it. Not every day, not obsessively, but watch the direction. Because the direction of that number is the single most important indicator of what is coming for every other asset class you own. If this connected some dots for you today, share it with someone who needs to see the whole picture before the picture changes on them, and I will see you in the next video.